Hey everyone, in this video I'm going to highlight one growth stock that's down 81% off its high that you might regret not buying while it's down. What is that growth stock? It is DigitalOcean Holdings. And so in this video I'll look at its revenue, profit, cash flow, and valuation to demonstrate why I think the stock is a buy right now. So let's jump right in with revenue. You could see here trailing 12-month revenue for DigitalOcean has more than doubled in the last 3 years, growing from around 300 million in January of 2021 all the way up to 650 million in the most recent trailing 12-month period. Now, while the growth rates have decelerated in recent quarters and the company has decreased the outlook for what it expects in terms of revenue growth in 2023, it's still growing revenue despite macroeconomic uncertainty. So the entire uh, I wanted to say enterprise services space has been decelerating in terms of revenue growth because businesses worldwide have slowed down their spending as a result of increases in interest rates because it makes the recession fears more likely. And so businesses have been more cautious, and so it's understandable that revenue growth rates have moderated. The next thing I wanted to highlight is DigitalOcean's operating profit margin. The company has been increasing its operating profitability in the last year or so from negative 7.5% up to negative 2.84%. As with many other enterprise business related companies, they too have pulled back spending in fears of a revenue slowdown. So DigitalOcean, like its peers, have pulled back spending, reduced hiring to some degree so that they can moderate the business given the slower revenue growth outlook. And most recently, there has been an abrupt change in leadership. The CEO they're searching for a new CEO right now. So that could also be creating some uncertainty around DigitalOcean, which could partly explain why the stock price is down so much so far off its high. Still, if you look at the company's cash flow from operations over the trailing 12 months, going back all the way to January 2021, you could see excellent growth in this metric, rising from around 50 million all the way up to 219 million in the most recent trailing 12-month period. If you would ask me why cash flow from operations is positive but operating profit is negative, the most likely reason for this for companies like DigitalOcean is stock-based compensation. That's a non-cash expense that DigitalOcean uses to compensate employees. And so that creates the difference between cash flow from operations and operating profit margin. And finally, DigitalOcean is trading at the cheapest valuation it's been at in a long time at a forward price to earnings of 14.23, a bargain valuation, in my opinion, for a company that's growing revenue, profit margin, and cash flow as quickly as DigitalOcean is at the last few years. So for all these reasons, I think DigitalOcean is one growth stock that's down more than 80% that you might regret not buying on this dip.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now.